Hello everybody, welcome back to another episode of Finance Agents Live. This is Tim MC and I'm joined today by the wonderful Rhoda Pflum. Thank you for coming on the show, Rhoda.
Thank you for the big heads up, letting me know I was going to be on the show today.
A lot of advance notices. We plan these things out maybe 6 months in advance, that's what she's saying. So 6 months ago we put it on the calendar. Or maybe 3 hours ago. Anyway, today we're going to be talking about an interesting...
bag of tricks.
It's always fun. Today we're going to be talking about an interesting equipment funding that just happened last week. And I thought that'd be an interesting thing for you to learn about because it is different than... I didn't even think we could do it. So that's awesome. Leave it up to Rhoda to...
That's me tooting my own horn.
Pull a rabbit out of her hat and make some magic happen. Today we're going to be talking specifically about getting equipment funding when you're in bankruptcy or something like that. Equipment funding with bankruptcies, we'll get into the more details. One thing I want to mention as we kind of dive into this, we're going to get into a specific scenario. And you may be watching this thinking, hey, that's cool for that super specific scenario.
And you're right.
But what you want to get out of it is, especially with equipment, but with a lot of different funding programs, it may sound like a lot of little specific random scenarios, but that's what it's made up with. Every deal, it's individual, has to stand on its own legs and can live or die randomly based on the ability for somebody to look around corners and fix problems. Pretty much everybody comes in with a problem. If somebody has no problems, they're probably going straight to the bank and they get an amazing super low rates because that's how the banks are. They either give you money at the lowest rate possible, basically unsustainable interest rates, or they come to somebody like us because it's not a slam dunk easy deal. And then they need people like us to look around. Well, it's a slam dunk once Rhoda gets on it. But this is why we exist, because it's never a straight line. It's always a crooked thing. You got to look around corners. You got to fix problems. And that's why we're here. So, all right, let's dive into this specific scenario. We had a client seeking financing to buy or purchase or lease or whatever the heck a used tow truck. All right, you do a lot of tow trucks, Rhoda? I feel like we get more long-haul trucking requests. We get those all the time. Yes. Tow trucking less. I mean, we've seen a few, but maybe less frequent, right?
Right, and I think a lot of that has to do with what you were talking about earlier, is the ease of getting a deal done. We see a lot of startup long-haul trucking trying to buy the used truck. And
because it's the easiest kind of equipment financing, right?
We'll go into that, why it's a little difficult. But yeah, the tow truck is not as difficult because it's not going around as much. This one was better because of the time in business. But yes, the tow trucks are definitely easier to get done.
All right, so here we are. We have somebody looking to get a used tow truck. And what about used versus new? Is one easier to finance than the other in your experience?
I wouldn't say one is easier, no. It's just going to impact the value of the asset and making sure that the asset is holds its value. You may have to do like a site inspection on this one, which we had to do, which might not be required for a used truck because it's on the lot and it's a new truck and they can see that on the title work.
Yeah, I would say with used versus new, there's kind of a trade-off, right? A new truck, you're not going to have to justify the valuation because it's the sticker price. Then again, the cost is going to be higher, and so it might be harder to finance a larger amount. On the used truck, it's a lower amount, which means it's easier to finance a lower amount than a larger amount always. But because it's used, you have to go through more due diligence to prove the value, right? So everything in equipment finance, this is, in my opinion, the most flexible type of financing. It fluctuates the most based on all the different variables. You could have some really horrible variables, and as long as the other ones are really good, they can counteract it. And that is kind of what we had here, where someone to come in to look in and get a piece of equipment that's not necessarily that difficult to finance, but with a real tricky scenario. We actually have a picture of the truck, Darren, if you want to throw that up there. There is the tow truck in question. It is real.
I want to add something before I forget.
Great.
So a lot of times people will want to know what they do if they find a truck at an auction. If I can interject that now.
Right.
What you do then is you get the auction house approved, and then you can go through the assets. So when you're starting to do that, I'm sure that you know the auction that you're going to go to, whether they have them once a week or once a month or however the used car auctions are in your area. We need to get the auction house approved first, and then we can move forward with the financing of the truck.
That's interesting. I personally haven't had a lot of experience with auctions. It seems to me like it'd be tricky, since so much is dependent on the value of the asset. you're going to go in and bid, and how does the equipment finance company know that you're not bidding some ridiculous rate over the value? I could see that as being a challenge, but that's an interesting note. You have to actually get the auction house approved first. Now, in normal equipment financing, you need to get the vendor approved, so I guess that's what this is.
Right.
If the vendor is the auction house, they need to know it's a real auction house and not some guy pretending to be an auction house who's really overinflating values in order to bilk money out of fake leases on things that are way overvalued, right? When I first got into funding, however many years ago, I talked to somebody.
A million years.
Yeah, a million years ago, something like that. That's what my kids believe. And I talked to somebody who had been around for a while, and they said, oh yeah, equipment financing is great. I remember some people were going around doing equipment financing for these $50,000 computers that probably were really only worth $1,000, and the people were walking away with a bunch of money. It was a way to trick the equipment finance companies. You can't do that kind of stuff anymore because they all got smart to that. Why? Because equipment finance companies are going to take the asset back if you default on it, and they really care about the real value of the asset. You can't do that kind of stuff anymore. So getting the auction house approved is one way they avoid those kind of problems.
Right. A lot of fraud in equipment finance is the vendor. The majority of fraud in equipment would be the vendor, not the person purchasing it. So there is some due diligence on that end.
Yeah, and not to besmirch Miami, but we had one equipment finance company that we worked with who said, we will never fund anything in Miami-Dade County because they had so much fraud there. There was one specific vendor, but it gives you an idea on it. Are you even allowed to do that? Is that considered redlining? I don't know. I don't know.
I don't know if you can do it or if there's like statistical data proving it or if it's not based on...
But yeah, that's what it was. All right, so let's talk about a tow truck. Is your impression that... We just talked about this. So a tow truck is not necessarily a difficult kind of thing, at least on the spectrum of things we see.
Right.
And that's why I made the joke about the long-haul trucks. Long-haul trucks is maybe the hardest. What are some of the easier kind of equipment financing to get, or some of the harder ones from ones you've done in the past?
So when you look at the industry or the financing as a whole, again, the long-haul startup trucking for used is probably the most difficult. And it makes sense when you think about it. If you have a startup who's buying a 2013 truck and he's just got one truck, you're going to have maintenance issues, and then his truck goes down and he's got a $10,000 repair. Now he can't make his deliveries, now he has no income, and now they have to collect on that assets because he's not making payments. So it's tough. The easier ones are the big yellow iron, the diggers, the things like that hold their value very well and are easy to resale. So when you think of it that, obviously startup restaurants are difficult because of the high failure rate, and then when you get it back, you have a used dirty fryer that doesn't have a lot of resale value. So thinking about those things, it makes sense when you think about, gee, would I want to buy a used fryer? Probably
right.
not. Do I want to buy a used backhoe? Yeah, that's still a good piece of equipment,
definitely.
Right? So, there you go.
Yeah, used restaurant equipment, the moment you install it, drops in value probably like half, maybe more, maybe 75%, because the resale is extremely difficult. All right, so tow trucks, not necessarily that hard to get, so that's good to know. What kind of...
Another thing, that we're seeing a lot that people may be able to relate to is people wanting to get equipment finance for their Uber fleet, to buy a car or two for their Uber fleet. And that's also difficult because it's really a consumer vehicle. You are looking at... Then you have to designate what percentage of the time is for business versus personal. And then when you get it into it, Uber drivers, I think, make something like $8-10 an hour. It's very low, so getting them to make that payment is difficult. So those aren't my favorite deals to see either. Okay,
Uber stuff. I know there's a lot of people getting into it, but really they're just financing their own car, and then they use it for Uber sometimes. So it's tricky. Anyway, okay, so... tow truck is not necessarily a difficult type of equipment to get financed. What kind of company experience are you looking to see when a company comes to you? There's 3 parts to getting equipment financing, right? Well, let's say 4 parts. You got the vendor, you got the borrower company, the creditworthiness of the person, and then the actual asset itself. So this asset is not that difficult. We already got the vendor approved. Let's talk about the company. What kind of things are you looking for in a company in order to qualify for tow truck financing?
Well, again, more is more. So if they've got over 2 years experience, that's great.
Really helpful.
Yeah,
Okay.
it is. Startups are always tough, particularly when they just have the one truck, because as I said, if that goes down, how are they going to make their payments? And so then it will come into the credit worthiness of the borrower and their personal experience.
So it's good if they have other trucks. Ooh, Darren's got a question.
Yeah, so
Darren wants a tow truck.
Well, going along with that, with experience, does that experience have to be in operation of the tow truck, or does it have to be in operating the company that is doing the towing?
There you go. That's an interesting question. So if the corporation has been around for 3 years and filing tax returns, but it's never had a tow truck before, that would be, there's two parts to that. The lenders definitely want to see company experience and money going through the business. You can't just have a shell corporation that you opened a few years ago and you never filed tax returns on. There's no money in it. That would disqualify. That's basically a fake company history. And the other side of it, if you've never done the tow business, you're basically a startup. They're going to look at it as a startup. You have a different opinion on that, Rhoda?
Yeah, and people with no experience, I really struggle to get done, particularly in trucking and restaurants. You've got to make the link. It's not as strong as 3 to 5 years experience like you would see with an SBA, but you got to, know what you're doing. In this case, the business had been open, I think, 6 years, 7 years, something like that, I don't remember. And she had been working there, but was the actual owner for 18 months. And so they considered her a startup. However, we were able to, show that she had been there for a long time and combine the two and get over that hurdle.
All right, so they're looking for business experience and personal experience. All right, so the business needs to have filed tax returns and have revenue, hopefully other trucks. That's definitely a help. And have experience in that type of business. So that's the business itself. Are they getting into business credit profiles? I feel like equipment financing is the only one that still sometimes pulls D&B reports or Experian Business.
And I was actually talking to someone about that yesterday. I said, how helpful do you find D&B? And he said, it's expensive. We're going to stop using it. I don't find it helpful. That the creditworthiness of the borrower is more helpful in the paydex score.
Right. Okay. So that's the company. Now let's get into the owner. What are the things you're looking for in the owner of the business in order to be able to qualify for equipment financing?
More is more. So I don't mean more derogatories is better. If you've got good credit and you can show comparable credit, that's great. I know some lenders, if they see a USAA or a Navy card on there, they will sometimes give you a better rate or term because you're a veteran or somehow associated with a veteran, so that can be helpful. Not all lenders do that, but that's helpful. They do want to see comparable credit, usually 5 lines, 3 to 5 lines, and something about the same amount. Mortgage is important. But it's not everything. If you don't have all of that, and again, there are A, B, C, D lenders, if you don't have all of that, your rate's going to go up, your down payment is going to go up. Just it's a whole big bag of tricks.
All right, so it's not just the credit score. They're going to look and see, have you ever done an equipment lease or a car lease or a car loan in the past? Do you have a mortgage so that we know we can come after your real estate assets? That's why they like mortgages, because they know they can attach your house if you get in trouble.
I've never seen that in equipment, that they attach a lien on your house.
Well,
exactly.
I think it's after the fact. If they sue you, it's easier to collect if you have a house, because if they get a judgment, then they can attach. I'm saying like after the fact.
Yeah, a lot of it is repossession of the asset itself, in my experience.
Right. Okay, so those are the things they're looking for. Comparable credit. Now, if you're getting a $50,000 truck, have you had a $50,000 car loan in the past? So you're calling that comparable, right? Do you think they include credit cards in that, or?
They're looking at your max credit card limit. If it's thin, $1,200, $2,000, and you've got 3 of them, it's not that great of a file.
Okay, and they want to see these things on your credit profile, all right? But if the business has done these things in the past, then they can look at that as well. All right, so what about the credit score? What do you think we're going to need? Again, equipment finance has the biggest range, so there are different scenarios, but what do you ballpark on the credit score you think you need for tow truck financing?
I would say across the board, I have more success with people who have a credit score over 600. I've definitely got offers for people 500, 550, not with a truck or something like that, but other assets. At that point, it's hard to close because the rates are so high and the down payment is so high that typically people with a 520 credit score don't have the required down payment to go through with the funding, but that's not to say we don't get offers for those people. They do exist.
Now, one thing, just random sidebar here that I've seen a lot is you got business owners that are out there that at some point got mad at the cable company and refused to pay a bill, and they end up with like $100 collection or something on their credit, and then they get angry. They're like, "Why are you going to deny me for funding because of $100?" But the reality is, the lender looks and says, "If this guy's willing to get a collection for $100." Then why the heck are we going to trust them with $50,000, right? So it's not insignificant. It's even more significant that they got a collection for such a small amount of money. It shows that they don't care about their credit. So if you're in that bucket, if you got that $100 you didn't want to pay to Verizon because you're mad at them, stop doing that. You're hurting yourself. Pay the $100, resolve the collection. It's better to have a closed one than an open one. It will have big consequences for when you try to get financing.
Right.
You're hurting yourself, man.
Pride. What is it? Cut off your nose to spite your face?
Yep, something like that.
Something like that.
All right, so let's get into this particular scenario. We had a business where there were bankruptcies. Let's talk about that. How did that work?
Well, so how it worked is they said, can we do someone in open bankruptcy? There were a couple owners. 2, I think they were husband and wife, and then the third, she had good credit, and she was the borrower. And I said
685. I looked it up.
Something, yeah. And so her credit was decent, and the other 2 were not. They were in open BK. And
open bankruptcy. That means
right.
Personal bankruptcy. They were in the process of going to court and having their assets liquidated and all of that. Now, normally, there's no way on earth you're going to get financing when you're in open bankruptcy. If your bankruptcy is already being discharged or closed or whatever, there's more options. This is pretty much the never option when you're in open bankruptcy. Right. So how were you able to work around that?
We needed to do a corporate restructuring on that one, and so the other 2, we had to have them file a statement of information with the state, and they restructured the business so that just the borrower with good credit, she was able to be the sole owner.
Now, it's interesting because if you have partners that are in open bankruptcy and they own part of the company, it's probably pretty dangerous to have them being owners at that point. And now I'm going to talk about stuff that I don't know about, but I don't know if you have to actually go through the courts. I don't know if you actually have to go through the courts to get permission to release their ownership in the company. That's a whole other thing. But, you don't want to have the business seized. So forget about the equipment financing. It was probably a smart move for them to restructure the business anyway until they solve all their legal problems. So it was probably a good move regardless.
We're not attorneys, though.
I am not an attorney, but bankruptcy is not a good thing to be in, and it is dangerous. So we had 3 owners, husband and wife, and another one. Basically, we did a corporate restructuring, removing the ownership from the problem people. Now, how did you come up with this? Was this your idea, or was it the lender you were working with?
Out of my own brain, Tim. I thought of it my own gosh darn self. Can you believe it?
Awesome,
I had a good idea.
All right, you think it would have worked with all lenders, or do you think they were willing to work with you on this one as an exception because everything else was looking good, or what do you think?
What do you mean?
Would
they have done it with the other 2 in open BK?
Do you think other lenders would do this, or you know?
I wasn't willing to do it with people in open BK. No, I don't.
You wouldn't have done it either. Okay. All right. Well, we got lucky on this one. This doesn't mean all of a sudden we want you to start submitting people to us in open bankruptcy. But and this is beyond just the bankruptcy thing. If you have businesses with multiple owners and some of the owners have bad credit, it might be a good idea to do a restructuring until that person can fix their problems. Even beyond this, that can help for a lot of different types of funding. Now, do you think you could work something like that for term loans? I think no. But have you seen this kind of situation before for SBAs?
We've done it, Tim. We talked about the...
What?
Almost like a leader. Out of my own brain, I thought of that. There was we had to keep her on because she was the one who had the experience working, the industry experience, so she had to stay on as I think 18% we made her, or 19% owner. So she was there and we could use her experience, but she wasn't, we weren't requiring her to sign on the loan.
All right, so we were able to do something similar for term loans. I know for the credit card program, you can use a guarantor, a second person with good credit. When the main owner has bad credit, create some sort of a partnership. With a retirement rollover, anybody who has the funds can roll it over. You don't need to worry about the credit at all. With private real estate loans, open bankruptcy is a problem, but there's ways to work around that. So, okay, good. So how long did it take in order to do this deal?
Well, there were other ups and downs through the deal. So the original owner of the truck, Ernie, he had a lien on it from U.S. Bank, so he didn't own the truck. And so we got a payoff letter from U.S. Bank, and so what the lenders will do in that case is they'll complete the payment to U.S. Bank, and then he'll receive the rest. But what he did was he just paid off U.S. Bank and then said, oh, I paid him off. And then we had to wait for him to get the title.
Okay.
So that slowed it down because they had to give the information to the state of California, and then the state of California had to send him the title. So that was a delay of about 2 weeks. I don't know. I think he thought he was helping, and maybe, but I think it would have been better if he had just kind of held off and let us pay off U.S. Bank, and then that would have shortened the time. But from start to finish, I think it was about 35-40 days because of that, paying it off. He lived in a rural area. There were some notary signatures and things that we had to go through, waiting for him to go into town to get the power of attorney notarized. The other problem was, so what people are doing now, rather than having a person go and do a site visit, they will send you a link and they will do a screen share with you or a video call on your phone.
Like a FaceTime kind of a thing.
Right.
Okay.
Skyping with you, and they'll say, oh, open the hood, show me this. And then you open the hood and show them that. Show me the tires. Then you show them the tires. Show me the this. Turn on the truck. Let me see the miles. But he didn't have a phone that had a camera on it, a video phone. So they sent someone out to do the site visit. We were able to negotiate and get a third party out there, and when he got out there, Ernie was sort of confused and said, no, someone else is coming, and so that delayed it a day. So there were some maybe miscommunications or misunderstandings that sort of drug it out a
Well, it's not
bit.
too bad if they're in open bankruptcy. I would imagine the corporate ownership changes might have added a little time to it as well. Either way,
that was the faster part. Maybe a week that took, but like the title, I think, was the thing that took it the longest.
Okay, all right. Okay, so that's it. We did the corporate restructuring. We have the actual deal structure for you on the screen here. If Darren wants to show it to you, I don't know if he'll be able to get it up, but $47,500. Sorry, Darren, I didn't mean to double entendre there. Financed was $47,500. There was a doc fee. Do you pay that doc fee in advance, or is that part of the closing? Doc fee of $500, and so the doc fee and the down payment of $2,500. Total due at signing was $3,000, and monthly $1,343. And that is for, do you remember, was it 5 years or something?
57 months.
57 months. Of course, everything's 57 months these days. Yeah, I don't get it either. But yeah, all right. So that's the deal structure. Now, if you're sitting there thinking, I want to send you some people in open bankruptcy that want to buy a tow truck and have 3 partners, great. If you had done that and sent it to us, then if you were a member office with us, the commission on that particular deal, and again, equipment finance fluctuates because it's going to be points and there's a lot of variables, but on this particular deal, the commission would have been $1,900 for a member office, $712.50 if you're a recruiter, or $475 if you're an agent and you just created the lead. So good money on all of that.
I think I forgot to put the sponsor on that one. Sponsor override would have been what, like $250, $225, $230,
Yeah,
something like that.
Okay, let's see. We had some questions that came in. Rick is asking, what can you add to the equipment loan to cover other expenses, if any? So let's get super specific first and just talk about a tow truck. I know if you're doing a build out on a restaurant, you can sometimes add in soft costs. But on the truck itself, I would think you probably couldn't add in other fees to be financed. Do you think it's any different than that, Rhoda?
Not on
I can't
a
imagine what
deal
you'd
like
add in
this,
there.
I don't know what you would. So
The trucker
when
cap?
well, I mean, so if you on this deal, when they did it, the tires were bald, and she needed to buy new tires. I don't think they would be willing to lend you money soft cost for tires or something like that. Or if you wanted to get the interior reupholstered, I can't see that. No.
Maybe the shotgun for the winter you're driving around a tow truck. You want? It's a dangerous business, man. You're towing people's cars. I'd be nervous. Oh, Darren's got a question.
Yeah. So I'm actually curious about kind of going along with what Rick is talking about here. If you finance the tow truck through equipment finance, but you need it, you're going to have an office and you need office furniture, or you need, a computer system, a POS system. Can that be financed through equipment finance, or are there other methods to finance those items for somebody who's building a business?
All right, Rhoda?
Yeah, so you can definitely do office equipment and things like that. And to go into that, not all of the equipment may be done through the same lender, particularly if someone has 5 trucks and they want to buy 3 more. Maybe one lender will do 2 trucks and then another lender will do 1 truck because they've reached the cap that they want to lend to this person. So you can see that, yes, equipment is, we're able to fund it. Some lenders specialize in different types of equipment, and you can do that. The problem I see with that is that when you're going to multiple different lenders, you'll have multiple down payments and doc fees and origination fees, and so it can become a little expensive, but it's better than not getting it, and so then you would get all of that stuff and you can just have multiple payments. So people do it 100%.
And of course, there's other types of funding as well. You mentioned, if you've been on the show, you get retirement rollovers, you get credit cards, personal term loans, business term loans, pretty much anything else we do, you can combine. And there's some conflicts between certain programs, but you get the idea. There's lots of other types of funding available. And when somebody comes in, we're always analyzing to see how do we get everything that's possible in order to help somebody accomplish their goals. With that said, a lot of times we say, hey, you want 100 grand, but looks like we can get you 35. And then it's about figuring out how we can make that 35 work for them instead of just walking away from the thing. If we can't get it for you, probably not going to get it because we've got more options than most anybody out there. Okay, next question. How about the bankruptcy? Can you get a loan if you just filed bankruptcy? I'm going to go to no, and then let Rhoda tell me I'm wrong.
Well, if you've just filed, no, because it sounds to me like you're still in open bankruptcy, which we went through with this one. I don't work those files. No.
Except for this one, because you removed those owners.
Right.
Right.
If it's been discharged, or dismissed, then you're not in bankruptcy anymore. But lenders still don't like that. You still present a risk, and so usually you like to be a couple years away from that.
Now, just so you know, if an equipment leasing company does a lease and then somebody goes into bankruptcy later, even though they're in bankruptcy, the equipment leasing company is still directly collateralizing the asset. They're not necessarily going to lose it. There's a big difference between unsecured finance and secured finance, like real estate, and directly secured assets like equipment. Those things do much better in a bankruptcy proceeding. But with that said, most lenders don't want to go anywhere near bankruptcy. It's just bad all around. So yeah, in general, if you just file bankruptcy, no. Now, there's people who file bankruptcy and then it gets discharged, right? That's when basically it gets rejected. Discharged is the term, Rhoda?
Correct.
All right. Rhoda always points out when you see somebody with discharged bankruptcies that they might actually be going around shopping for more debt so they can go back and file bankruptcy again and then qualify. There's this weird thing where they say you don't have enough debt to qualify for bankruptcy, and then they go get more debt and then file. So that's something we watch out for. It's a real thing. But if the bankruptcy is already, so discharged means you got rejected. What is it? What's the word when it's completed? It's
when
not a D
it's
word.
dismissed.
Dismissed.
Yeah, and so then after that, you kind of are, in a weird way, the safest risk because you are prohibited from filing bankruptcy for, depending on if it's Chapter 7 or 13, from 2 to, I think, 7 years you can't file, or 10 or something like that. So you can't file again, but that doesn't mean that you still you're obliged to make payments or somehow have figured out how to manage your debt. So
Yeah, they got rid of debtor's prison. That's not a thing.
No,
So
not in this country.
fortunately, kind of hard to make the payments if you're in prison. Anyway, so that's it. Here's a particular deal again. We went over it. It's going to sound a little overly specific, but it's how we look at every deal. Every deal comes in and we say, well, this is what they're looking for. How do we spin that Rubik's Cube in order to have success? Which fortunately we did. Hopefully we can help you with your deals, or our member offices can in the future. And that's it. All right. Thanks everybody for coming on the show. Thank you, Rhoda, for walking us through this equipment finance amazingness. And we look forward to doing a lot more deals together.
A lot more deals together. It's like